And welcome to the NCSL webinar, our third webinar in our Employment and Labor Summer Series. This webinar will be covering unemployment insurance financing systems, comparing tax systems and funding systems for unemployment insurance across all 50 states. So we're going to give it just a couple of minutes for people to sort of file in. While we're waiting for people to file in, if you could put your state that you're watching this from in the chat so we can see who's watching and where everyone's from. I see Michigan and Oregon and Kentucky, Illinois, Minnesota, Colorado, Virginia. Wow, all over the place. What a great group. California, Washington, Ohio, Wisconsin. Lots and lots of people today from all over. Fantastic. Well, I'll go ahead and start. So a general overview, this presentation is going to cover first a broad overview of the current state of unemployment insurance funding. We'll cover solvency, trust fund, Title 12 loans, and tax measure reports. Then we'll dive deep into the sort of basics of unemployment insurance tax systems. And then we'll close with a legislative overview of the most recent 2021 enacted legislation related to unemployment insurance funding. For those of you who don't know, NCSL is a membership-based organization serving state legislators and their staff. We are a nonpartisan, bipartisan organization, which means that we do not take policy positions, and we also don't do anything related to model legislation or policy recommendations or anything like that. And with that, I'll go ahead and go into the broad overview of the current state of unemployment insurance funding. So this is a map of all of the states with current Title 12 loans or Title 12 advances from the Treasury to help cover funds, expenses related to unemployment insurance. You can see it's a fair amount of states sort of across all the different regions of the nation. The amount of funding that states currently have out in Title 12 loans varies pretty greatly. Some, for example, on the low end, like Maryland, have about 68 million in loans currently. And then California currently is at the top with just a little bit over 22 billion. And all the other states that are highlighted in green there exist somewhere in that range of funding. This is from the 2021 Department of Labor Solvency report. So every year, the Department of Labor publishes a report on the solvency level and sort of how well-funded the current state's unemployment trust fund balance is. So this is coming out of their measure of average high-cost multiple. The states highlighted in green have a solvency level of at least 1, which means their average high-cost multiple is at least 1. The average high-cost multiple is measured as the reserve ratio, which is the trust fund as a percentage of total wages at the end of the calendar year, immediately preceding the report year, divided by the average high-cost rate. And the reserve ratio is the total estimated covered wages of the prior year. Average high-cost rate is the average of the highest 3 calendar year benefit costs rate in at least 20 years or in a period including at least 3 recessions if longer. Now, I know that was a lot of formulas. NCSL does have a web page covering sort of the basics of how these things are calculated and think about that have visualizations of the formulas as well. So if that sounded like word salad to you, I encourage you to visit the web page as well. This is a map of states in green that currently qualify for no interest loans. Currently, all states qualify for those loans based out of initially the CARES Act and then expanded by the American Rescue Plan Act. However, states can also qualify for no interest Title 12 loans if they meet 3 basic criteria. And we'll go over those criteria in the next slide. But currently, all the states in green would qualify or do qualify for Title 12 no interest loans, even if the CARES Act and American Rescue Plan Act extension were not in place. And then finally, we have states that have an adequate minimum tax rate. So this is coming out of the 2020 report from the Department of Labor. We are still currently waiting on the 2021 Department of Labor. But the average tax rate is the average tax rate on taxable wages estimated from the total contributions received divided by the total taxable wages for the year. The minimum adequate finance rate is formulated by taking the average cost benefit rate plus a solvency amount. The average cost benefit rate is equal to the average of the previous 6 calendar year ratios, not including recessionary years, of total benefits paid to total taxable wages. The solvency amount is equal to the difference between the state's current trust fund balance and including any outstanding balances as of January 1st. And the trust fund balance needed to have an average high cost multiple of 1 divided by 5 divided by taxable wages. For states with a 1.5 average high cost multiple, a negative solvency amount subtracted from the benefit cost is included. The amount is equal to the amount of trust funds exceeds the trust fund balance is needed to have an average high cost multiple of 1.5 divided by taxable wages. So this is a map of states that have this tax rate of above sort of the average minimum tax rate. It ranges pretty broadly. So the highest percentage is Vermont, which has a 214% average tax rate above the minimum. And then the lowest that is above 0 is Rhode Island, which is 3% above this average tax rate above the minimum adequate financing. Again, we have pages sort of explaining this in more detail with visuals if that sounded like a little bit too word salad. So moving into sort of explaining tax rates in general, first we'll talk about criteria for loan, no interest loan eligibility. There are 3 categories. There is solvency. Then the state must have an average tax. Then there's the average tax rate for the last 5 years and the average tax rate for the last year. For solvency, the state must have achieved at least a 1 in average high cost multiple, or must have been considered solvent in the last 5 years. If the state has not met that goal in the last 5 years, they are not eligible for the Title 12 loan. On top of that, they must have their lowest percentage of their average tax rate in the past 5 years must be above 75. This value must not be below 75%. And then for the last year, their average tax rate cannot be below 80%. So if a state meets all 3 of these criteria, then they are considered eligible for the no interest Title 12 loan, regardless of sort of what other temporary actions may have been taken by the federal government related to this. Moving into state UI tax systems broadly, there are 3 sort of buckets in which the taxing can happen. There's the federal taxes coming out of the Federal Unemployment Tax Act, or FUTA. There are state taxes, which states may do on top of the base FUTA taxes. And then in 3 states, Alaska, New Jersey, and Pennsylvania, there are also taxes levied on the employees themselves related to those taxes. So first we'll talk about FUTA, or the Federal Unemployment Tax. Under the provisions of FUTA, a federal unemployment tax is levied on covered employees at a rate of 6% on wages up to $7,000 per calendar year paid to a worker in covered unemployment. The law also provides credits against the federal unemployment tax liability of up to 5.4% to employers who pay state taxes timely under an improved state employment insurance program. These credits are allowed regardless of the amount of tax paid to the state by the employer. Accordingly, in states meeting specific requirements, employers pay an effective federal unemployment tax of 0.6%, or a maximum of $42 per covered worker per year. The credits against the federal unemployment tax may be reduced if the state has an outstanding advance, commonly called a loan, or the Title 12 advance, as we mentioned earlier, from the federal government under Title 12 of the Social Security Act. A state may obtain a loan from the federal government when the state lacks funds to pay UI benefits To assure that these advances are repaid, federal law provides that when a state has an outstanding advance balance as of January 1st of 2 consecutive years, the full amount of the advance must be repaid by November 10th of the second year, or the credit available to employers will be reduced. This functions as a tax increase. The amount of the reduction increases annually until the advance is repaid, unless certain conditions are met. Federal law provides for certain limits and exceptions to this critical credit reduction. Interest is charged on all advances made April 1st, except in the case of cash flow loans, or temporary provisions providing for the waiver of interests included in federal law. The interest rate is the lesser of 10% of the rate of interest paid on the state reserve balance in the unemployment trust fund for the last quarter of the preceding calendar year. Interest payments may not be made for the state's unemployment fund. When a state has an outstanding loan balance on January 1st for 2 or more consecutive years, and the full amount of the loan is not repaid by November 10th of the second year, the FUTA credit will be reduced until the loan is repaid. Basic reduction schedules consist of 3% annual increment and credit loss. For 3 or more consecutive years, if it's not been paid for 3 or more consecutive years and the full amount of the loan is not repaid by November 10th of the tax year, then from the third year on, an add-on may apply on the amount of state's average tax rate on total wages if in the amount of the state's average tax rate on total wages is below a threshold defined by 2.7% times 7,000. If the state has an outstanding loan for 5 or more consecutive years and the loan is not repaid by November 10th of the tax year, then on the 5th year, a benefit cost rate of BCR add-on may apply if the state's tax rate on taxable wages is lower than its 5-year benefit cost rate, or 2.7%, whichever is higher. These taxes then are paid to the Treasury and then go into these trust funds that the states manage. The trust funds that are the federal unemployment tax funds pay for the following costs: federal and state administrative costs for the UI program, federal share of benefits paid under the Federal State Extended Unemployment Compensation Act of 1970. Then funds from which an individual state may obtain advance whenever the state's trust fund lacks funds to pay, and labor exchange services under the Wagner-Payzer Act, employment and training services for veterans and disabled veterans, and some labor market information activities. Then we move on to state taxes. States provide an assignment of contribution rate of 5.4% or higher to enable employers to receive a maximum credit of 5.4% against the federal tax. In all states, an employer pays a contribution rate based on its experience. In all states, new and newly covered employers pay a new employer rate until they meet the requirements for the state's experience rating. In some states, additional contributions are required when fund levels drop to specified points, or to restore amounts expended for non-charged or ineffectively charged benefits. Non-charged benefits are those benefit costs charged to general accounts rather than to individual employer accounts. Ineffectively charged benefits include those benefits charged to inactive and terminated accounts, and those charged to an employer's experience rating accounts after the previously changed benefits to the account were sufficient to qualify the employer for a maximum contribution rate. In some states, state UI agencies collect additional taxes imposed on employers' payrolls. Although the revenues for these additional taxes are not deposited in the state's unemployment fund, they sometimes serve as UI-related or employment and training purposes. Taxes that are collected but not paid into the state's unemployment trust fund are listed later in this presentation. In every state, an employer who has overpaid contributions based on the laws in effect at the time is entitled to a refund. These refunds may be made within time limits ranging from 1 to 6 years. In a few states, there are no time limits specified. Then finally, we look at employee contributions. Again, Alaska, New Jersey, and Pennsylvania levy UI taxes on workers themselves. UI the taxable wage base is the same that is applied to employers, except in Pennsylvania, where employee contributions are calculated via the gross total covered wages. So now we'll look at taxable wage basis. So this is the base level at which the percentage of the UI tax is levied. So there are the states in blue just sort of set a baseline. States that are in green have an indexed taxable wage base that may be based on a variety of factors. And states in orange have a taxable wage base that fluctuates depending on the balance of their trust fund. So talking about wage bases in general, almost all states have adopted a higher taxable wage base than that applicable under FUTA, that's $7,000. And these states, an employer pays a tax on wages paid to or earned by each worker within the calendar year up to the specified amount in the base. In addition, most of these states provide an automatic adjustment of the wage base if the federal unemployment tax is amended to apply to a higher taxable wage base than that's specified under state law. Some states have also established flexible taxable wage bases that are automatically adjusted either on unemployment levels or on solvency levels coming from the annual solvency report or on the balance in their trust fund. Next, in the sort of calculation of each individual employer's tax, we have experience rating. So there are four main ways that each state may calculate their employer's experience ratings. And I'll cover each of these in the presentation here. So the ones in blue are states that use the reserve ratio formula. The reserve ratio was the earliest of the experience rating formulas and continues to be the one used by the majority of states. The system is essentially cost accounting. On each employer's record are entered the amount of payroll, contributions, and benefits paid to workers. The benefits are subtracted from the contributions, and the resulting balance is divided by payroll to determine the size of the balance in the terms of potential liability for benefits. The balance is carried forward each year under the reserve ratio plan. Ordinarily, the difference between the employer's total contributions and the total benefits received by workers since the employer became subject to the state's UI laws. Rates are assigned according to a schedule for specified ranges of reserve ratios, and the higher the ratio, the lower the rate. Also, fluctuations in the state's fund balance can affect the rate the employer will pay. An increase in the fund may trigger a tax rate schedule in which a lower rate is assigned, and conversely, a decrease in the fund balance may trigger a tax schedule requiring a higher rate. Next, we'll look at the benefit ratio formula, which is all of the states in green. The benefit ratio formula also uses benefits as a measure of experience, but eliminates contributions from the formula and relates benefits directly to payrolls. In theory, the theory is that if each employer pays a rate that approximates their benefit ratio, the program will be adequately financed. Rates are further varied by the inclusion in the formula of schedules, effectively at specified levels of the state's funds in terms of dollar amounts, proportions of payrolls, or fund adequacy percentage. Unlike the reserve ratio, the benefit ratio system is geared towards short-term experience for employers. Next, we'll look at the benefit wage ratio, which is the states in orange, DC and Oklahoma, or Delaware and Oklahoma. The benefit wage formula is pretty different from the previous ones that we've discussed. It makes no attempts to measure all benefits paid to the workers of individual employees. The relative experience of employers is measured by the separation of workers, which results in benefit payments, but the duration of the benefits is not a factor. The separation weighted with the wages earned by the worker with each base period employers are recording on each employer's experience rating record as benefit wages. Only one separation per beneficiary per benefit year is recorded for one employer. The index, which is used to establish the relative experience of employers, is the proportion of each employer's payroll, which is paid to those workers who become unemployed and receive benefits. Then finally, we'll look at the system used by Alaska, which is the payroll variation plan. The payroll variation plan is independent of benefit payments to individual workers. Neither benefit payments nor any benefit derivatives are used to measure unemployment under this formula. Experience with unemployment is measured by a decline in the employer's payroll from quarter to quarter. The declines are expressed as a percentage of payrolls in the preceding period, so that experience of employers with large and small payrolls may be compared. If the payroll shows no decrease or only a small percentage decrease over a given period, the employer may be eligible for the largest proportional reductions. The Alaska also keeps it over a 3-year period, and they. Where is that? Alaska is currently the only state that uses this system. Next, we'll move on to sort of some general things to consider when thinking about unemployment taxes writ large. So there are rates and rate schedules. Again, talking about sort of earlier adjustments to the taxable wage basis. Some states also have adjustments to the rates on those taxable wage bases based on things like levels in unemployment in the state, whether or not the larger economy is in a recession, job gains, trust fund balances, all of those sorts of things. There are also adjustments to minimum and maximum rates. Those are generally set at that 5.4%, so that employers get that maximum federal credit reduction, but there also may be increases or decreases based on the economic situation. And then finally, a handful of states also have limits on how much that increase, either in the taxable wage base or the tax rate, may increase between any given fiscal year. Next, we'll look at some taxes that are happening sort of outside of the taxes collected to go directly into trust funds. So the states in green have special taxes levied on employers to help with interest loans and interest repayment. Some states have the authority under state law to sell bonds to pay benefit costs, thereby avoiding the need to obtain federal advances. In these states, special taxes may be assessed to pay off the bonds and any costs associated with the bonds. Additionally, federal advances are generally subject to interests. States that take out federal advances may not pay interest from the state's unemployment fund, and several states have established special taxes to pay the costs of this interest. These are the states highlighted in green. Then these states highlighted in green are states with taxes to set up reserve funds. Some states, again, have the authority under state law to collect taxes which are deposited in a reserve fund. Unlike employer contributions, which are held under the federal unemployment trust fund until needed to pay benefits, these reserved fund monies are not subject to the federal withdrawal standard, which restricts the use of contributions to the payment of benefits and other specific purposes, which I listed earlier in the presentation. The principle of the reserve fund is generally used for UI purposes, though a state may redirect the reserve fund to sort of other programs or uses. Generally, these are sort of rainy day funds that may be used in a recession in which a state can put these reserved funds into their unemployment trust fund to help pay benefits. Then finally, the states highlighted in green here are states that have additional taxes for either administrative or non-UI benefit related purposes. So purposes that are outside of the listed ones that only federal taxes can be used for, or funds in the unemployment trust fund can be used from. The purpose may be UI administration, job training, employment services, special improvements in technology. These taxes are not deposited in the state's unemployment trust fund, but in another fund designated by state law. So then we'll move into sort of what we're seeing related to enactments. If we could go ahead and take a quick little break, because I know I've done a pretty large info dump on a lot of really in the weeds information. If you could, in the chat, please note any sort of interesting legislation that you may be seeing in your state related to either unemployment or unemployment funding or state taxes and solvency. And while that's happening, I also want to remind everybody to please post any questions that you have in the chat, and I will be sure to get to them at the end. So while we're waiting for people to post any interesting bills in their state, I'll talk about what we're tracking currently at NCSL related to enacted legislation at the state level for taxes and solvency. We've seen 8 bills enacted in 2021 so far. And then since 2010, we've seen 328 enacted across all 50 states. Some notable bills pulling out of the 2021 enactments. There's North Carolina Senate Bill 114. This provides 2021 coronavirus relief measures for employers and claimants under the unemployment insurance systems to reduce the state unemployment tax avoidance rate for 2021 and makes some technical clarifying or changes requested by the Division of Employment Security. There's New Jersey Senate Bill 3033, which concerns contributions for unemployment compensation funded by employee leasing companies. Mississippi House Bill 509, which allows for withholding of unemployment compensations for state income taxes. Maryland Senate Bill 496, which provides certain financing during the fiscal years of 2021 and 2022 for the purposes of relieving the adverse effects of the pandemic, allows for the beginning of allows for this beginning within a certain taxable year, and the subtraction under Maryland income tax from certain unemployment insurance benefits. Also, Kentucky House Bill 433, which creates some new code and taxes related to their unemployment trust fund. And then next, we'll look at enactments related specifically to state unemployment taxes. So we've seen 7 bills enacted in 2021 specifically related to state unemployment taxes, and about 44 bills enacted since 2010. Some notable bills include the Delaware House Bill 65, which provides COVID-19 relief for both claimants receiving unemployment benefits and employers who are assessed unemployment benefits and taxes, and extends the date of the Secretary of Labor's COVID-19 related rulemaking authority. And it looks like we have a question coming up. So the question is, in North Carolina, there's been a discussion of using the state's UI trust fund reserve to essentially forgive overpayments that were paid out during the pandemic. So we have not seen any sort of enacted legislation, at least that I can remember in our tracking, related to that. However, I think there have been a couple of introduced pieces of legislation, and I'm happy to pull out the introduced pieces of legislation and send that to you as well. And so with that question, we will move on to the questions. So in general, before we get to questions and answers, I wanted to remind everyone sort of how to stay in contact with NCSL. We have multiple pages related to unemployment insurance. We have a page on funding systems, which is a lot less in-depth as this presentation was, but sort of provides a general overview of how to think about funding and financing systems. We also have a page on overpayments and fraud, and we have multiple general pages, including pages on WorkShare, unemployment insurance large, and our tracking database. If you have questions, you can also email me directly, and I can provide answers to those questions in some of our 50-state charts and things like that as well. And then finally, we'll open it up to any other questions from the group. And it looks like there are no other questions. So again, if you have any specific questions, feel free to email me at zach.herman@ncsl.org, and I'm happy to answer any other questions that you have. And I will get the information on introduced legislation to the question asker as well. Thank you so much.